My first question revolves like development process. I want to know how developers actually get paid, and going off that, I read about a tax credit, and I would like for you to explain that as well.
So first of all, there's no one way that developers get paid. So the way that we always approached the business from Jump Street was different than I think most people approach the business, and I think it's benefited us in the long run. So what we decided to do was basically just, for lack of a better word, is take all of our chips, push them into the middle of the table, and if we won, we got paid. If we lost, we did not get paid. We had to go scrape, beg, borrow, and steal. Not steal, but beg and borrow to do the next deal. So we always got paid based on the profitability of the deal. If you poke around and talk to some great entrepreneurs, especially guys, like Mark Cuban on Shark Tank and all that stuff, you'll see that they highly advise no salary, eat what you kill when you ultimately cash out. So for us in real estate, it would be purchasing a house, putting all our resources into that house, borrowing money, putting that into that house, maybe raising a little equity, putting that into the house, renovating the house, selling the house, and then once it was finally sold, if there was, X dollars left over at the end of the deal, that money would be split between the partners or kept by us if we owned the entire deal. That's how we always got paid as developers.
Gotcha.
Then a little bit later on, when we were doing a little bit more volume, that was tougher, right? So that worked for 1, 2, 3, 4, 5 deals. But when we got to the point where we had 6, 7, 8 deals going on, we had a lot of resources that were in the deal, or in all of those deals. And you have to staff up, too. It's tough to staff up and really build a business if you're just waiting for profit to come in from sales. Because real estate development is probably the least, because we're in a lot of different businesses, I could say this, but it's the least efficient business in the world. You spend a whole bunch of time finding an opportunity. Then you take money and put it into that opportunity. Then you take more money and put it into that opportunity. And you keep feeding it and feeding it and feeding it until you have an opportunity to sell it. And if you are correct, you sell it for what you thought you were and you make money. So it's nothing but cash outflow before there's a penny of cash inflow.
Gotcha.
That's really an inefficient business. So the other way, once we had a lot of deals going on, with putting a lot of money into it, is we started collecting what you might call like a management fee or a construction management fee. So, example, this sounds good, but you're just basically pre-pulling profits from the deal. So it's not what I would recommend if a guy was going out and flipping a house or anything like that. But you basically have these development projects which have construction components to them. So say, for example, I have 3 projects and they all have $100,000 construction budget. As I put in for construction draws on that $100,000, I would mark it up by 5 or 10%. Say it's 10%. So if I need 100 to build something, I'd borrow 110. So every construction draw I took, say I put a roof on and I put in for $20,000 construction draw release from the bank, I would keep 2. And that $2,000 would be what would be keeping the lights on, for example. That's industry standard. That's another way developers make money. The third way is through acquisition fees. So as I started looking at much bigger transactions, in 2009, me, my partner Oliver, who originally started Conquest with me, and some other folks that we met in Dallas, we ended up basically pooling resources and raised a little bit of money. We bought a big apartment complex. It was a 176-unit complex in Houston. So we knew the guy who operated it. We raised $1 million, and we were part of the deal. To this day, I couldn't tell you what my ownership percentage was. I think it was 15 or 20% or something like that. But it was split amongst the developer, the capital raisers, and the actual capital. But what I learned in that transaction was that on big deals, we had a purchase price of $2.9 million. We raised $1 million in equity. Your total acquisition cost was $3 million. So the person who finds the deal, i.e. in this case, the developer operator, he made a 3% acquisition fee on that trade. So it was a $30,000 fee he got paid for putting that whole deal together. irrespective of performance.
Gotcha.
Then he also got construction management fees. Do you have a developer top of mind that you've heard of or look up to or anything like that?
Gadles Development?
Marcos, he's such a kiss ass. So like this is a little bit speculative, but I think I'm probably pretty accurate with it. So say you look at, you ever heard of the Related companies? Steve Ross. He's the owner of the Miami Dolphins. Steven Ross owns a company called Related. They're probably the biggest developer in the world. Or you could actually Google the story of Donald Trump and Trump Tower if you wanted to. It's a very good story. The way that these guys would make money, basically they'll find a piece of land, raise the capital for the piece of land, close on the land, take an acquisition fee, probably between 1% and 3%. Then they would come up with the construction budget, hire a general contractor. They'd probably make some sort of administrative fee. So you'd see the acquisition fee labeled as developer fee, and then you'd see like the construction management fee listed as like ongoing services fee. And then when they sell it, they get the profit. That's really how it's done. It's done in three ways. One is an acquisition fee, two is construction management fee, three is actually the profitability of the deal. Yeah, the tax credits they're pretty complex. Mm-hmm. So, for example, you've probably heard of tax credits in the context of opportunity zones. There's tax credits for solar. There's tax credits for like lower income neighborhoods and building housing in lower income neighborhoods. But basically, the way that works is the government identifies an area that needs to be, gentrified, regentrified, built up, whatever. But the cost to build is often a lot more than the economics would dictate you could charge for rent. So basically, what the government says is, hey, you can only charge this much rent. We know it costs a lot of money to build it, so we're going to offer you tax credits to go ahead and do this.
Gotcha.
So, for example, if I was a developer who wanted to take the tax credits, I would do that development. Say they'd offer me $1 million in tax credits. I would basically, and I say I made $2 million in a year, I would have $1 million that I no longer owed the government. Does that make sense?
Yeah.
So like I'd get a text like, oh, Ryan Gadles owes us $100,000. Nope, I'm going to use $200,000 in my tax credits. You get what I'm saying?
Yeah.
The other way people do that is they put together these developments and they do what's called tax credit syndication. So basically they'll have the ability to, instead of going to the open market and raising capital and saying, hey, family office, we need $100,000. We're doing $1 million project. Hey, so-and-so. They basically get to sell the tax credits. So what they'll do is they'll take that $1 million in tax credits. It equals the $1 million they need, and they go sell those to raise equity. So somebody will say, hey, I'm looking to build this giant development. I have $1 million in tax credits. I'm going to sell them to Bank America, who's a big tax credit buyer. I'm going to sell them to JP Morgan. I'm going to sell them here. And basically, they'll give you $1 million in cash for the $1 million in tax credits, and they'll become a partner on the deal. You get what I'm saying? That's called tax credit syndication. Very complicated. I've never done it. I know people who've done it. I know people who've bought in opportunity zones and developed for tax credits, but tax credits are basically a commodity which allows the owner of the tax credits to have a dollar for dollar reduction of income tax due.
If there was anything at all that you liked in that video, you're welcome. If there's anything you didn't like, blame Marcos. But either way, like, subscribe, comment, whatever suits you.